Guessing it's probably somewhat longer than that. Bundesbank President Joachim Nagel, who sits alongside us, bank policy, is someone who has made the 11, 12, 13 to make the trek out to Jackson Hole.
I think, as always, the Jackson Hole conference is a very important conference for central bankers, but maybe this year even more important. And when it comes to central bank independence, this is the DNA of good monetary policy. This is the conditio sine qua non to do what we have to do to fulfill our mandate, to achieve price stability. And so central bank independence, we have to fight for it.
Do you have any fear that that has already been compromised in some capacity in the Federal Reserve, which people used to call the central bank to the world?
Let me put it like this. I don't want to comment on U.S. politics. I hear one or the other comments I really do not like. But just to point out, to give you maybe a kind of a reminder when it comes to the history of my country, Germany, going back to 1948, and we are grateful to the United States that you gave us an independent central bank. This was the starting point for the famous German Wirtschaftswunder. So central bank independence is key to achieve price stability, to build the basis for economic growth. So we have to take this into account.
This is critically important, and to me, this Jackson Hole is far more international than any other Jackson Hole I've been at. Bill Rhodes' great phrase, central banker to the world. Jerome Powell has to speak today to the developed nation central banks and also fragile EM central banks as well. What's the message you need to hear from Chairman Powell that reaffirms independence at a central bank?
Jay Powell gave many important, relevant speeches here in Jackson Hole. And this year, I guess, for him, it's a very important meeting. It's his last meeting in this role, giving such a speech. And what I expect from him, he is an outstanding, excellent central banker. And what I expect from him to deliver a clear message on price stability and the mandate of central banking, and this is price stability. And so he gives us this certainty we need in a very complicated world.
I want to ask this question. Bill called me up this morning and said, let's get Nagel in trouble. So here we go. I want you to talk
making him nervous.
I want you to talk not about American exceptionalism, but from where we sit, there's Leica exceptionalism, Mercedes exceptionalism, everything of Germany that we know. Tell us now about the future of German exceptionalism that you have to steer forward with monetary policy.
I think Germany, we are in a situation that is definitely not an easy one. When you take the second quarter numbers for GDP, it was minus 0.3. So this year we expect maybe stagnation or a mild recession. But what I can tell you and what I can promise to you is that Germany has the capability to adapt to different situations. I think the world is changing. We are not happy with the current situation, so the trade conflict and everything is definitely not helpful. But at the end, we showed in the past our, let me say, strengths to come back and have a strong economy.
Post-Trump, can you and France and the other leaders of Europe reaffirm that growth, that spirit of growth that you had?
I guess we do something in the moment. We are going in the direction that you alluded to. We have structural reforms. We will do a lot of spending in new investments over the next year. So I think we do a lot of things in the moment, and I can guarantee you that there is a strong coalition on the European side. Germany, France, this axis is working again, and so I'm really confident that we can achieve a lot.
Given the fact that you could see some sort of mild recession in Germany, are you open to cutting interest rates further after getting to 2%, which is sort of balanced? Is it appropriate to become a little bit more accommodative?
Maybe a mild recession for this year, yes, this is true, but maybe we have also to think about that next year economic growth, there's a high probability that economic growth is coming back. Well, it's definitely not time for complacency. So, taking, for example, service inflation.
in case you missed it on Balance of Power.
The president says grocery prices are dropping. Is that what you're seeing?
If you go back to COVID and everything, they've obviously gone up since then. I think you see a pause in grocery prices right now because we don't know what to do as far as buying goes right now. The other big one that hit us today was this. India grows most of the shrimp in the world right now.
Wow.
And now this, what do we do now? This just got 50, is it 50% or 25%? I don't even know.
So how long do you think you can sustain margins here if these tariffs do not change? You mentioned the holidays. Is that when this starts to kick in?
Yeah, we're hanging by our fingernails right now. I mean, we can't do this forever. And I'm hoping all of Trump's tariff deals and everything will work themselves out.
Don't miss Balance of Power live every weekday.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, central bankers travel to Jackson, Wyoming, and we go with them to the richest county in the country. In Dallas, we take a look at its plans to challenge New York's position on top of the financial world.
Wall Street is great. The future is Dallas.
And we sit down with Chevron CEO Mike Wirth to hear what he's doing to restore some balance after all the ups and downs of fossil fuels. Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
I don't see any chance that there's a nod toward a September cut or any promise of a September cut. I think he's going to focus primarily on the decision framework and not give any indication of where he's leaning for September.
That was former Fed Governor Betsy Duke. As everybody waits for that key speech in about 14 minutes' time, we will hear from Fed Chair Jay Powell here in Wyoming. This is Bloomberg Surveillance on television and radio. As we count you down to that speech, we do see in markets a sense of calm after 5 straight days of losses, after a lot of gains, Tom. We've had a big market gain this year. We did see we saw a pause, an August pause, 5 days of losses, and now we're up about 0.5% on the S&P and seeing yields come in just slightly.
I take umbrage. We've forgotten what a correction is. We've forgotten what a bear market is, and we've forgotten what a 35% drawdown is.
We could still mention that markets were down for 5 straight days
because
in a row.
Because we're Abramowitz, and that's what we do. We got
even though you did see a 13% increase for the S&P 500. This is going to go in circles.
We're going to be flames is what we're doing.
Right now. Let's have someone save us. Michael McKee is going to join us, and he's going to try to weigh in on this.
Am I going to save you?
You're going to save us. Absolutely.
I'm going to save you.
But also who's going to save us is a former Philadelphia Fed President Patrick Harker, who joins us here on set after a sojourn in Yellowstone. You wonder why everyone knows now. Everybody knows that you are hiking in Yellowstone. We've been talking about this with everyone, that it feels very different this time around. How much behind closed doors do all of the Fed members talk about the importance of central bank independence? Is that something very much at the forefront of their minds?
It's essential. It's absolutely essential. We know history, right? We know when that gets lost, what happens. We know that in this country, and we know it in countries around the world. So it is absolutely critical, the independence of the Fed. That does not mean the Fed is not held accountable. I think this is important. Independence doesn't mean you get to do whatever you want to do. There is still an accountability. There's an accountability to Congress, and there's an accountability to the markets, right? There's an accountability to the American people more generally. So I think you can't lose sight of that.
There is an argument that ultimately, if there is a policy on the Fed, whether it's response to political pressure or not, to ease now, and then inflation picks back up, the markets will be the ultimate arbiter, right? That ultimately you will see some sort of market reaction that will be a natural check on whatever that is. Do you ascribe to that?
Yes, the bond markets. I mean, I look at the bond markets. Equities, they're choppy. They're always choppy. The fixed income folks, they're making longer term decisions. And so that's what I watch. And I think that's right. They will police the Fed in some ways. Because monetary policy flows through the markets. That's the implementer of monetary policy, not the Fed. The Fed moves one rate, the overnight rate. It's the market that make monetary policy work.
So today, Jay Powell gets up with the markets anticipating a rate cut.
Yeah.
What does he say? Does he care what the markets are doing right now? Does he make the point that there's a lot of data? Does he open the door to a rate increase?
Yes.
Cut.
The answer is yes to all those things. I think Jay will be cautious. I think he will try to, my own sense, move things more to neutral. That is, there's a possibility of a September cut. I mean, if I think back these 7 weeks ago when I left the Fed, my last SEP, I had 2 rate cuts in for this year. I think that's still appropriate. There's one other tool, though, that he's not going to signal, which I think is important to put on the table, which is the balance sheet, right? We're talking about the rate cut, but the balance sheet runoff, my own view is I think the Fed should stop the runoff now, right? And that's a signal that we want to sit here and see how things play out, and then maybe in September a cut or later. But I think the balance sheet, we often forget about it. Again, it's small now because we slowed the rate, but it's still there. And I think it's an important signal that we want to sit and wait. We are entering a period I'm worried about. It's not the 70s, but it does feel like stagflation light, right? It doesn't feel great. When I talk to my contacts, there's something that just doesn't feel right.
Well, what's the balance of risks right now? Because we've heard a lot of your former colleagues say, we're worried about the labor market, but it still seems to be solid. We're worried about inflation, although it's only ticked up a little bit. We think it might in the future.
So I'm more worried about inflation in some ways because the labor market numbers are hard to discern right now. You think we're shrinking the labor force in some ways, right? And so we're keeping unemployment steady-ish. It's going to tick up, but steady-ish. So we're not going to see those big numbers of 100,000, 200,000 jobs. Part of it is because the labor market's shrinking.
We are mourning here at this Jackson Hole a wonderful guy, Charlie Plosser.
Yes, we are.
Just died. He was head of the Philadelphia Fed before you. I want you to recapitulate here right now, freshwater optimism about the American economic experiment that was with Finn Kinlan, Ned Prescott, and Charlie Plosser in Real Business Cycle Theory. Explain how that innovation isn't going to go away, even with the political intrusion of the moment.
No, I mean, Charlie was one of my mentors, and I just have tremendous respect for him. I was a director of the Fed when he was president, so I got to know him well. I knew him as a business school dean when I was a business school dean. He made tremendous contributions to education, to economics, and not just in macroeconomics, but economics more broadly. And so he's going to be really missed. And he was an incredibly strong and powerful voice for Fed independence.
Speak about centrist America, centrist Republicans, centrist Democrats that took, within the criticisms of RBC, said, you know what, this is about America and this is about our spirit. Is that at risk right now?
Yeah, so people would ask, what am I, a hawk or a dove? And I say I'm an eagle because I'm from Philadelphia. But now...
I don't get it.
Oh, God.
Ask people from Kansas City. They'll tell you all about it.
Ooh, sick bird.
But I consider myself right now a radical pragmatist, a radical centrist. We've got to get the center to rise up in the spirit of what Charlie and his colleagues did and reaffirm the centrality of markets, reaffirm the centrality of democracy. Those two go hand in hand. Human agency is what it's all about.
So we're about 7 minutes ahead of this speech, and one thing that you talked about a year ago when we were sitting here was something that stuck in my mind for the rest of the year, which is that at this point you are looking at anecdotes with almost more importance than the hard data, that gave you a more real-time view of things. How much is that even more so now, given some of the questions around, forget the politics of the moment, just the collection of data, the surveys that people aren't responding to, things of that nature?
Oh, yeah, just look at employment, right? You have the establishment survey, the household survey, those two aren't quite adding up. There's a lot of choppiness in that data right now. And so, you have to take that data seriously. And you have to be careful not to make anecdotes data, right? But you do need to listen to what people are saying. And people right now are sitting on their hands. What I'm hearing from lots of people is, I need to let some of this uncertainty. Now, the only exception to that are data centers, right? It's roaring ahead. The only problem is we don't have enough power to power these data centers. But there are areas of the economy that are growing, but a lot of people are just waiting.
Can I note here, Mike wants to get a question in. The temperature's dropped since we started live.
Oh, it feels warmer
It's gone
than usual.
43
I'm
to
not complaining.
Do we expect snow today?
Oh my gosh, it is actually warmer than usual.
Tom is
Mike.
not an outdoorsman.
Yeah.
42 degrees.
You can see Pat sitting there just in a sport coat.
Yeah,
He's
understatement
fine.
of the
We're
year.
all
Carry
fine.
on.
I want to ask you about the framework review, which is something that Mr. Powell is likely to talk about today. What's the most important change that they are likely to make?
If you read the framework review, it was written in a period where we thought interest rates were going to be zero or low forever, right? And inflation was going to be under 2%. And so there was that color to the previous review. That's all going to be taken out, obviously. And I hope I haven't seen the final, right? But I hope that they then emphasize more a balanced approach and more principles as opposed to tactics. Right? We don't need to get into the details of the tactics. That's what the committee does. They need to reassert the principles of the dual mandate.
Well, going forward, under whatever new framework they have, do you think they can eliminate some of the risk that we saw coming into 2020 when Jay Powell here unveiled the last framework, which less than a year later was being junked because of COVID?
Yeah, you know, I get this question a lot. Like, before I went into every meeting, FOMC meeting, did I review the framework and that guided my decisions? The answer was no, right? You face the situation you have in front of you, and you deal with the cards you're dealt with. And so the framework provides a broad sense of where the committee needs to go, but day to day, meeting by meeting, it does not drive the decision.
Wait, this is too important. This is breaking news. Do you read the Fed minutes?
Yeah.
Wow, redhead.
I was in there, yeah.
Exactly, of course. He actually listens too. I am wondering, though, what the risk reward here is, and just to sort of crystallize the moment, what the harm would be of cutting by 25 or 50 basis points. And you talked about how you penciled that in. It wouldn't be that big of a deal. Are we just making these big, grand pronouncements about the same thing, that essentially it might make sense to cut on the margins, but not necessarily go wholesale to 1%? I mean, is that essentially what everyone seems to be coalescing around?
I don't see how you would go 1%, right? I mean, that's just simply not in the cards. 25 basis points, what matters is not the number, but the signal it sends, right? Because what the Fed is, because it's 25 basis points going to move the 10-year? No, not really. The market's going to move the 10-year. It's more the signal of where the Fed thinks the economy is, right, and where it's going. That's why I like the idea of pausing the balance sheet runoff as a signal. These are signals, not actual, they're not going to be reflected in people's mortgage rates or credit card rates.
Before we let you go, how much are people talking about who's going to come in to replace Fed Chair Jay Powell?
Well, all the time. You guys are talking about it all the time.
I mean, among the Fed members.
Yeah, that I don't know. I mean, I haven't really, part of my deal when you leave the Fed is you have to sort of stay on the sidelines for a while. I mean, obviously people are concerned about that. It's a very important position for this country. And so, yeah, I'm cheering for the team that's making this selection, that they make the right choice.
Patrick Harker, thank you so much for being here. Really appreciate it, and I guess go Eagles. Patrick Harker, former Philadelphia Fed president. We are awaiting that speech from Chair Powell, who is going to be speaking here in Jackson Hole in less than 3 minutes' time. Mike, we have been hearing from a number of people the fear of a 70s type of stagflation light. Not exactly 70s, but that seems to be the emphasis so far in the Fed speak we've heard so far.
Well, it's the data that we're seeing. We're seeing a slowdown in the labor market. We're seeing an increase in inflation, but I think the emphasis at this point would be on the light part of it, because it's nothing like what happened in the 1970s. And this is also very early in the process. We recognize what's going on because of what we went through the last time, so the Fed can react. And in the current framework, and I assume this will stay in the future framework, the Fed will do whatever it needs to do to keep price stability. That's going to be their main focus. And if that's the case, then hopefully they are ahead of any stagflation.
Totally unfair question to you, but I'm going to go with it. With a new framework, whatever it may be, does the Fed become ever more ex post, after the fact waiting for data?
It's going to depend on how you define it, because what the Fed is going to do is take out the idea that we're going to make policy based on what we think is going to happen. And they're going to say, we're going to look at all the data that comes in. So it could be ex post, or it could be just consensus.
Do the dots stay?
Look, the dots it's all the communication tool. And how do you communicate? Maybe get on Twitter. I will say that we are waiting for Jerome Powell to come out and give his speech. We're less than a minute away. Unclear exactly how he prepped for it. How do you think he prepped?
He had breakfast at the Pioneer Grill.
You saw him?
I said good morning to the chairman this morning, and I did not see if it was, I didn't see if he went healthy or full English.
Oh, yeah.
But,
I can guarantee he didn't go full English ahead of this, but this is going to be a monumental moment for him. His last speech at Jackson Hole as Fed chair, with the whole world watching. Does he address independence? Does he deal with the inflation side of the mandate more than potentially the labor market side of things? And frankly, the international feel here, really notable, as you mentioned.
To me, that's a major theme for me, is the international community is screaming.
Yeah. Micah has some headlines.
The headlines are out. The chairman has started speaking, and here is the key phrase. The shifting balance of risks may warrant adjusting policy. That's going to get Wall Street's attention because it's opening the door to a rate cut. Here's the key sentence. With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. The Fed is also announcing its new framework, which is pretty much as we were just talking about with Pat Harker, dropping the reference to the effective lower bound, eliminating the inflation makeup strategy, committing to contain inflation expectations and concern about labor market shortfalls. But the key here is that there are downside risks to employment. The Fed chairman says the inflation outlook is that it will rise, but perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising, the S&P 500 now up 1.3%, yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
They do anticipate that tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking at these as one-time price adjustments within each sector. So it's likely that inflation is going to go up, but then they think it stabilizes and might go down again.
Well, right now, let's take a listen to Jay Powell, chair of the Federal Reserve.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework, as captured in the revised Statement on Longer-Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted. Goals are in tension like this. Our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago. And the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation and the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the make-up strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised